We've only just had the biggest tax changes in a decade, yet rumours suggest more tax changes are coming as part of the UK Spring 2025 statement on March the 26th. This year it's particularly important as it follows major reforms announced last year that are set to take effect in April 2025.
I'll have to turn to the country and make big asks of you as well, to accept short-term pain for long-term good.
Today, we're diving into the most credible rumours about what might be announced and what they could mean for you. From potential tax hikes to reforms targeting businesses and high earners, we'll break it down with insights from trusted sources like Contractor UK, City AM and the Telegraph. At the end, we'll also look at the economic forecast driving these potential changes and how you can prepare now before these potential changes are implemented. First, let's discuss what the Spring Statement actually is. The Spring Statement is a key fiscal event in the UK, often described as a mini budget, though its impact can be anything but small. Unlike the Autumn Budget, which lays out comprehensive fiscal policies for the year ahead, the Spring Statement acts as a mid-year review. It allows the Chancellor of the Exchequer, in this case Rachel Reeves, to assess the economy's performance and make adjustments to existing policies or introduce new measures if necessary. This year's Spring Statement comes at a critical moment. The UK economy is facing several challenges, including slow growth, persistent inflation and rising public debt. According to Frank's accountants, there is still a £22 billion funding gap in public finances that needs to be addressed, even after the £40 billion in taxes were announced in the last year's autumn budget. Many of these tax increases are set to take effect in April 2025, making this Spring Statement a vital opportunity to refine or adjust these measures before they're implemented. Accompanying the statement will be an updated economic forecast from the Office of Budget Responsibility, also known as the OBR. These forecasts provide essential insights into key metrics like GDP growth, inflation rates and unemployment levels, and also public debt. They help shape the fiscal decisions and give businesses and taxpayers a clear understanding of what lies ahead. While it's not as comprehensive as the autumn budget, the Spring Statement still remains a pivotal moment for UK fiscal policy, particularly given the economic pressures that are currently at play. Now we understand this, let's discuss the rumoured changes. First, we have Employer National Insurance Contribution, also known as NICs. One of the most contentious topics ahead of the Spring 2025 statement is the planned increase in the Employer National Insurance Contributions, NICs. From April 2025, the rate for employers is set to rise from 13.8% to 15%, and the threshold in which employers start paying NICs will drop from £9,100 to £5,000. These changes are expected to raise billions in additional revenue for the government, but they have sparked significant backlash from businesses and charities. Employer NICs are a direct cost of employment, and increasing rates or lowering thresholds means a higher expenses for businesses. Small businesses and charities in particular argue that these changes could force them to cut back on hiring, reduce wages or even lay off staff. For many organisations still recovering from the economic impacts of COVID-19 and Brexit, this represents another significant financial burden for them. According to Contractor UK, there are rumours that Chancellor Rachel Reeves might use the Spring Statement to introduce relief measures for some businesses and charities. One option could involve raising the secondary threshold back above that £5,000 mark. Another possibility is further increasing the employment allowance, already set to rise to £10,500 in April 2025, which helps small businesses offset their NICs liabilities. Targeted relief is also being discussed for specific sectors, such as charities or small enterprises. Whilst these measures could ease some of the burden, critics do argue that they may not go far enough in addressing the broader impact of rising costs on employment and also business growth. Next, we have income tax thresholds being frozen for longer. Following the planned changes to employer NICs, another significant issue looming over the Spring 25 statement is the government's ongoing freeze on income tax thresholds. This policy, first introduced in 2021 and set to last until 2028, has already been a major driver of increased tax revenues for the government. However, reports from the Telegraph suggest that Chancellor Rachel Reeves may extend this freeze even further, potentially pushing it beyond 2028 to raise additional funds for public services. Under the current freeze, the personal allowance, the amount you can earn before paying any income tax, remains at £12,570, and while the higher rate threshold stays at £50,270. Ordinarily, these thresholds would rise annually in line with inflation or wage growth to prevent taxpayers from being pulled into higher tax brackets. By freezing them, the government allows more people to pay higher rates of tax as their income increases, a phenomenon known as fiscal drag. This policy has already had a significant impact on middle income earners. For example, someone receiving a pay rise to keep pace with inflation could find themselves being pushed into a higher tax rate bracket, even though their real purchasing power hasn't increased. Extending the freeze beyond 2028 could add thousands of pounds to the annual tax bills for millions of workers. And while this measure is expected to generate billions in extra revenue for the Treasury, critics do argue that this disproportionately affects middle income households, those already struggling with rising living costs. With inflation forecasted to average 2.7% in 2025, according to the OECD, fiscal drag will continue to erode disposable incomes. Reeves may face pressure to adjust this policy in response to public outcry. According to City AM, there is speculation that she might announce targeted relief or exemption for lower income earners during the spring statement to soften its impact. However, extending this freeze does remain a strong possibility, given the government's need for additional revenue amidst high public debt levels. Next up at number 3, we have changes to capital gains tax. Building on the potential extension of the income tax threshold freeze, another major area of focus ahead of the spring 2025 statement is capital gains tax, also known as CGT. This tax, which applies from profits made from selling certain assets like property, but excluding your main home, shares or business interests, is already set for significant changes in April 2025. However, according to Bishop Fleming, there are rumours that Chancellor Rachel Reeves could announce further adjustments to address growing backlash from investors and entrepreneurs. Under the changes announced in the autumn 2024 budget, CGT rates are scheduled to rise. These increases align CGT rates more closely with the income tax rates, a move framed as a step towards fairness in the tax system. Critics argue that these changes could discourage investment and entrepreneurship by making it more expensive to sell assets and to reinvest the proceeds. For example, it is expected that landlords and property investors may delay selling properties, therefore reducing liquidity in the housing market. Similarly, business owners looking to sell their companies could face higher tax bills, potentially impacting their retirement plans or reinvestment opportunities. According to Contractor UK, Reeves may use the spring statement to introduce targeted relief for specific groups affected by these changes. One possibility is enhancing the business asset disposal relief, formerly known as entrepreneurs relief, which allows qualifying individuals to pay a reduced CGT rate of 10% on gains up to £1 million over their lifetime. Expanding this relief could help offset some of the impact on entrepreneurs selling business assets. And there is speculation that Rachel Reeves might introduce exemptions for certain types of assets such as green investments or employee-owned businesses. And whilst these measures could soften some of the blow for taxpayers, they are unlikely to fully address the concerns about the broader economic impact of higher CGT rates. For investors and business owners, timing is critical. Completing asset sales before April 2025 could save you thousands in taxes under current rates and allowances. However, with the potential tweaks still on the table, all eyes will be on Rachel Reeves during the spring statement to see how she balances fiscal discipline with support for economic growth. Another rumour circling around is on stamp duty land tax, SDLT. Following the potential changes to capital gains tax, another area of concern ahead of the spring 2025 statement is stamp duty land tax. This tax, paid when purchasing property or land in England and Northern Ireland, is set for significant adjustments in April 2025. According to T's law, stamp duty thresholds are expected to revert to pre-2020 levels, which could make property transactions more expensive for most buyers. Currently, the threshold at which stamp duty kicks in is at 250k for residential properties, following temporary increases introduced during the pandemic to stimulate the housing market. However, this threshold is set to drop back down to 125k in April 2025. These changes are expected to generate substantial revenue for the Treasury, but have raised concern about their impact on housing affordability. First-time buyers and those purchasing lower value properties are likely to be hit the hardest, particularly in regions where even modest homes often exceed the 125k mark. Critics argue that reversing thresholds could price out many potential buyers and could slow down the market activity. So, to address these concerns, there is speculation that Chancellor Rachel Reeves may introduce targeted reliefs or even incentives during the spring statement. For example, expanding first-time buyer reliefs currently available on properties worth up to 425k could help to offset rising costs for those entering into the housing market. Another possibility is introducing stamp duty discounts for energy efficient properties, encouraging green investments whilst also easing the financial burden on buyers. For landlords and property investors, higher stamp duty surcharges could make expanding portfolios or selling properties less attractive. However, targeted incentives such as tax breaks for retrofitting homes with energy efficient upgrades could help to provide opportunities for those willing to invest in sustainable housing. With housing affordability already a pressing issue and inflation driving up living costs, Reeves faces significant pressure to balance revenue generation with support for house buyers. The spring statement will likely clarify whether these changes will be accompanied by relief measures or if buyers will need to prepare for higher transaction costs starting April 2025. Next, we have the widely reported VAT on private education. The introduction of VAT on private school fees, implemented in January 2025, has been one of the most controversial tax changes in recent years. Private schools are now required to charge 20% VAT on tuition fees, a move that significantly increases costs for families who rely on private education. This policy was introduced as part of the government's broader effort to raise revenue and redirect funds into the public education system. However, it has sparked widespread criticism from parents, schools, and educational organisations. The rationale behind this change is to level the playing field between private and public education. By removing the tax advantages previously enjoyed by the private schools, many of which operated as charities exempt from VAT, the government aims to generate billions in additional revenue. These funds are then expected to be invested into state schools to improve facilities, teacher salaries, and resources. Critics argue that this change disproportionately affects middle income families. While wealthier families may be able to absorb the additional costs, those who have made significant financial sacrifices to afford private education are now facing tough decisions. For example, a family paying £15k a year in tuition fees will now need to pay an additional £3,000 in VAT. Many parents are considering transferring their children to state schools, potentially putting further pressure on the already overstretched public education system. Private schools themselves have raised concerns about how this policy could impact their financial sustainability. Smaller institutions with tighter budgets fear that they may struggle to remain viable if a significant number of students leave due to higher fees. This could lead to closures or mergers within the sector, reducing the availability of private education options. There is speculation that Chancellor Rachel Reeves may use the spring statement to address some of these concerns. And while it is unlikely that the VAT measures will be reversed, City AM reports that Reeves might announce additional funds or support for public education or targeted relief for families affected by rising costs. For example, subsidies for state schools in areas where demand increases, or incentives for private schools offering scholarships could help to mitigate some of the fallout from this. For families with children in private education, these changes highlight the importance of financial planning. Exploring options like scholarships, bursaries, or payment plans offered by schools could help to offset rising costs. Meanwhile, any announcements made during the spring statement could provide further clarity on how families and schools might adapt moving forward. In addition to the rumours that we've already discussed, We also have potential adjustments to inheritance tax relief. Inheritance tax is another area of speculation ahead of the spring 2025 statement, with potential changes to relief for agriculture and business properties sparking concern amongst farmers and family business owners. You may have seen in the news there have been recent massive protests in London as a result of this. Agricultural property relief and business property relief can reduce the taxable value of qualifying assets by up to 100%, making them vital tools for preserving family farms and businesses across generations. For example, a family farm worth £2 million can currently be passed tax-free if it qualifies for agricultural property relief. The proposed cap would fundamentally change this dynamic. Estates exceeding that £1 million limit would face significant tax liabilities, forcing many families to sell off parts of their businesses or farmland to cover the cost. Critics argue that such a change could disrupt rural economies, where farms often serve as both economic hubs and community cornerstones. Similarly, small business owners warn that higher tax burdens could jeopardise their ability to pass on enterprises to the next generation. Supporters of this change do argue that these reliefs disproportionately benefit wealthy landowners and cost the Treasury billions in lost revenue each year. By capping these reliefs, the government could raise funds for public services whilst also ensuring that only smaller estates continue to benefit fully from these exemptions. According to Bishop Fleming, Reeves may consider phasing in any changes gradually or introducing sector-specific caps to mitigate the impact on vulnerable industries like agriculture. Another possibility is raising a cap above £1 million for farms and small businesses, whilst applying stricter limits to other types of assets. For families with agriculture or business assets, now is the time to review estate plans with a financial advisor. Strategies like lifetime gifting or transferring assets into trust could help mitigate potential tax liabilities if these changes are introduced. The spring statement will likely clarify whether these adjustments will move forward and how they will be implemented. Another thing we'll probably hear more on is the digital transformation of HMRC. The digital transformation on HMRC is expected to feature prominently in the spring 2025 statement, with updates on the government's flagship Making Tax Digital initiative likely to be announced. This initiative is also known as MTD. MTD represents a major overhaul of the UK's tax reporting system, aiming to modernise how individuals and businesses interact with HMRC by mandating digital record keeping and real-time tax submissions. And whilst this initiative has been rolled out gradually since 2019, the next phase is set to bring in millions more taxpayers, particularly landlords and small business owners, into its scope. Under MTD, taxpayers are required to maintain digital records of their income and expenses using approved software and submit quarterly updates to HMRC instead of filing an annual tax return. The goal of this is to reduce errors, improve compliance and close the tax gap which costs the Treasury billions of pounds each year. Businesses registered for VAT already have been required to comply with MTD since 2019, and initial reports suggest that this has improved accuracy in VAT filings. However, the rollout of MTD for income tax self-assessment, originally scheduled for 2024, was delayed until April 2026 to give taxpayers more time to prepare. When implemented, landlords earning over 10k annually and sole traders with similar income levels will need to comply with MTD for self-assessments. This will require them to use compatible software for record keeping and submit quarterly updates. For many small businesses and landlords who currently rely on spreadsheets or manual methods, this represents a significant shift and potentially a costly one for them. According to Deloitte, the spring statement may include announcements about support measures for those transitioning into MTD. These could include grants or subsidies to help small businesses offset software costs or phased implementation timelines, prioritising larger entities before expanding to those smaller taxpayers. There's also been speculation that Reeves might introduce additional incentives for early adopters or extend exemptions for those below certain income thresholds. And critics argue that whilst MTD's goals are laudable, it places undue burden on smaller taxpayers who may lack the resources or technical experience to comply. Software subscriptions can cost hundreds of pounds annually, and many individuals may need professional assistance to navigate the new system. Additionally, concerns remain about whether HMRC's infrastructure can handle the increased volumes of data submission. For those affected with these recent changes, preparation is key. Landlords and self-employed individuals earning over £10,000 annually should start exploring compatible software solutions now and familiarise themselves with these digital record keeping requirements. Many providers often offer free trials or discounted rates for early adopters, making it easier to transition ahead of the April 2026 deadline. The Spring Statement will likely provide crucial updates on how this initiative will proceed and whether support will be available for those affected. It's also worth considering the economic forecast is driving these changes. The economic backdrop to the Spring 2025 Statement is critical to understand why many of these proposed tax changes and adjustments are being considered. The UK economy is navigating a period of modest growth, persistent inflation and high public debt, creating a challenging environment for policymakers. According to projections from KPMG and the OECD, GDP growth in 2025 is expected to reach 1.7%, marking an improvement from the 0.8% growth seen in 2024. However, this level of growth remains below historical averages and is heavily reliant on government spending and household consumption. One of the key drivers for this modest growth is the fiscal expansion introduced in the autumn budget of 2024. Increased public spending on infrastructure, healthcare and education provided a temporary boost to domestic demand, helping to offset some of the economic stagnation experienced in late 2024. However, this fiscal stimulus has also contributed to persistent inflationary pressures. The OECD predicts that the UK inflation will average 2.7% in 2025, the highest amongst G7 nations, due to strong wage growth and elevated costs in the services sector. Inflation remains a significant concern for households and businesses alike. While energy prices have stabilised after sharp increases in previous years, domestic price pressures, particularly in services, are proven harder to control. This sticky inflation is eroding purchasing power and increasing costs across the board, making it more difficult for businesses to invest and for consumers to spend freely. Monetary policy adjustments are also shaping the economic outlook. The Bank of England has begun gradually cutting interest rates, reducing them from 5% to 4.75% in late 2024, with further reductions expected throughout 2025. Analysts predict that rates could fall as low as 3.7% by year end, providing some relief for borrowers and potentially stimulating investments. However, these cuts are implemented cautiously to avoid exacerbating inflationary pressures. And public debt remains another critical factor influencing fiscal policy decisions. The UK's debt to GDP ratio is projected to rise to 92.8% in 2025, up from 85% just 5 years ago. This level of public debt limits the government's ability to introduce new spending measures or provide significant tax relief. According to Street's accountants, this lack of fiscal headroom means any additional spending or tax cuts announced in the Spring Statement will need to be carefully balanced against revenue-raising measures such as tax increases or reforms. Labour market dynamics are also playing a role in shaping the economic landscape. While unemployment remains low by historical standards, businesses are facing rising labour costs due to increases in national living wage and the employer national insurance contributions. These higher costs are putting pressure on the profit margins and could lead to slower job creation or reduced hiring in certain sectors. The Office of Budget Responsibility, OBR, will release its updated economic forecast alongside the Spring Statement on March 26th, providing crucial insights into these trends. The OPR's projections will cover key indicators such as GDP growth, inflation, unemployment, public debt, and offering a comprehensive picture of the UK's economic health, and helping to shape any new measures Reeves may announce during her address. Finally, let's discuss how you can prepare for these potential changes. With potential changes coming into effect from the Spring 2025 Statement, taxpayers, businesses and investors need to start preparing now to mitigate any financial impact. While the exact details of Chancellor Rachel Reeves' announcements remain speculative, there are several proactive steps you can take to safeguard your finances and adapt to the likely outcomes. For businesses, plan for rising costs. The planned increase in employer national insurance contributions is a top concern for businesses. From April 2025, NIC rates will rise from that 13.8 to 15%, with the threshold dropping from 9,100 to 5,000. These changes will significantly increase employer costs, particularly for small businesses and charities operating on tight budgets. To prepare, review payroll budgets. Assess how these changes will affect your overall costs and explore whether adjustments such as delaying new hires or streamlining operations are necessary. Also, look to utilise relief. Check if your business qualifies for the employment allowance, which is set to increase to $10,500 in April 2025, as this can help you to offset some of your NIC liabilities. And also prepare for digital taxation. If you're a small business earning over £10,000 annually, you'll likely need to comply with the Making Tax Digital by 2026. Start transitioning to compatible accounting software now to spread out the cost and ease the learning curve. For property buyers, you want to time your purchase. Changes to stamp duty land tax thresholds could mean that property purchases become more expensive from April 2025. The stamp duty land tax threshold is set to revert from that 250k to 125k, while surcharges for properties may rise from 3% to 5%. To prepare, act before April 2025. Try completing property purchases before the changes take effect, as this could save you thousands in stamp duty land tax. For first-time buyers, keep an eye on potential reliefs being announced in the spring statement. And also consider energy-efficient properties. With speculation around stamp duty land tax discount for energy-efficient homes, investing in properties with high energy ratings could provide long-term savings. And for investors, look to optimise asset sales. Explore gifting or transferring. Transferring assets between spouses or gifting them during your lifetime may help to reduce CGT liabilities. Consult a tax advisor for guidance on this. And for families, look to adjust your budget for educational costs. If you have children in private education, the introduction of VAT on private school fees has likely increased your expenses by 20%. And while this change took effect in January 2025, Reeves might announce targeted relief or support measures during the spring statement. In the meantime, seek financial assistance. Many private schools offer scholarships or bursaries that can help offset tuition. Also, you could consider public education alternatives, with public schools potentially receiving additional funding due to this policy shift. Exploring state education options may be worthwhile considering if private school fees become unsustainable for you. Next, for farmers and business owners, you want to review your estate plans. Rumours of caps on inheritance tax relief, particularly agricultural property relief and business property relief, have raised concerns amongst farmers and family business owners. These reliefs currently allow qualifying estates to pass on assets with little or no inheritance tax liability, but this could be capped at £1 million per estate. To prepare, consult an estate planner. Review your estate plan with a tax specialist who can help you to explore strategies like trust or lifetime gifting. Also, plan asset transfers early. Transferring agricultural land or business assets before any changes are implemented could help you to preserve more of your estate's value. Staying informed is crucial as we approach March 26, 2025. Whether it's updates on NICs relief, stamp duty land tax thresholds, CGT adjustments, or support measures for families and businesses. Understanding how these changes affect your circumstances will allow you to act quickly and effectively. By planning ahead and seeking professional advice where needed, you'll better position yourself to navigate whatever comes in the spring statement. Please let me know what you think to these potential changes in the comment section. And don't forget to like and subscribe to hear more about any additional changes as they're announced.